With peace talks collapsing and tensions escalating after the US moved to counter-block the Strait of Hormuz, one thing is becoming increasingly clear. This conflict is not ending anytime soon. And while the headlines are focused on military development, the real story lies elsewhere, in the global economy. Whenever the conflict hits the Middle East, oil prices surge, and this time is no exception. Brent crude prices have spiked sharply. Let's break this down simply. As supply of oil chokes up in the Strait of Hormuz, not only the oil price spikes, but all other items leading to uncontrolled inflation. At global headwinds, we are looking beyond the battlefield, into the financial shockwaves seriously denting the entire world economy in general and the US economy in particular. And the fact that the US is the anchor for the global economy makes the foreseeable future all the more unstable. Stock markets world over are tanking, currencies are tumbling. While stronger economies are somehow managing the onslaught, the weaker ones are scurrying for cover. But here is where it gets interesting. Oil, like many other natural resources, is not distributed evenly. So while most of the oil wells are located in the Middle East, Central Asia, Russia, and Americas, these regions are the privileged few in the world. So who hurts the most? Asia and Europe. Countries like China, India, Japan, South Korea, Indonesia, and Singapore depend heavily on imported oil. Together, they account for over 30% of the global economy. Rising oil prices mean higher production costs, rising inflation, and ultimately slower growth. China in particular sits in a very delicate position. It has long relied on Iranian oil, often navigating around the sanctions. But if the US actions directly disrupt these supply lines, China's energy security and economic stability could take a significant hit. Then comes Europe. The European Union contributes over 15% to the global GDP. Yet more than half of its oil needs are met through imports. So just like Asia, Europe is vulnerable. Higher oil prices will feed into the inflation, slowing already fragile economic recovery. While many economies struggle, on the other side of the spectrum, a few actually benefit. The United States and Russia. Let's start with Russia. After years of sanction and the ongoing Ukrainian conflict, Russia's oil exports have been under pressure. But now with the Middle Eastern supplies disrupted, Russian oil is back in demand, especially from countries like India and China. In a strange twist, this conflict could stabilize Russia's economic outlook, at least in the near term. Now about the United States. At first glance, the US seems well positioned. It is one of the world's largest oil producer, and with the global supply tightening, demand for American oil rises. But this advantage may be short-lived. Because beneath the surface, the US economy has deeper vulnerabilities. As of April 2026, US national debt is nearly $40 trillion, about 122% of its GDP. Add to that the cost of war estimated to more than $200 billion and rising daily. And the fiscal pressure becomes very significant. Meanwhile, ordinary Americans are already feeling the impact. Gas prices have jumped from under $3 per gallon before the conflict to over $4 now. Inflation, which seemed under control earlier this year, is rising again. One reason for this is that the United States imports heavier crude from Canada, which is more suitable for refining in its refineries. With prices moving north, it's quite logical for pump prices to go up. And this is just the beginning. The real long-term risk lies in something far more fundamental: the US dollar itself. For decades, the dollar has dominated the global trade, especially in oil. This petrodollar system ensured that the countries needed the US dollars to buy oil, reinforcing its status as the world's reserve currency. But that system depended on one key promise: security. The US guaranteed protection to major oil-producing nations in the Middle East. In return, those nations sold oil in dollars. Now that equation is being questioned. If countries like the Saudi Arabia, the UAE, the Qatar, and Kuwait, and others begin to doubt US security guarantees, especially in the face of ongoing attacks, what happens next? If they start exploring alternatives to the dollar for oil trade, even gradually it could weaken the very foundation of the US financial dominance. And for an economy carrying massive debt, a weaker dollar is not just a currency issue, it's a systematic risk. Because if the US economy slows, the impact won't stay contained. Countries around the world depend on the American demand. A slowdown in the US means reduced exports, lower global growth, and a cascading economic effect worldwide. So while this conflict may seem regional, its consequences are anything but. From oil prices to inflation, from national debt to the future of dollar, this is a crisis that could redefine the global economic order. And the biggest question remains, if the war continues, who really wins? And more importantly, how much will the world have to lose?